Precious metals are on fire, with gold knocking up against $5,000 an ounce. Silver has broken $100 an ounce just today. Platinum is setting a new all-time high. It's just been an incredible run this week for precious metals, driven by a couple of different factors, one of which is President Trump's trip to Davos and the Greenland negotiations and the tariffs on, tariffs off over NATO nations about Greenland that have created a lot of uncertainty in the world this week. But there's something else that's happened that fundamentally is creating much more uncertainty, I believe, and is potentially much more problematic that you're not hearing very much about. And that's the focus of this gold market commentary for Friday, January 23rd, 2026. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. If we can help you with any of your needs in the physical precious metals arena, we'd love to have that opportunity. In this gold market commentary, gold knocks on $5,000 an ounce. Silver is actually over 103 as I tape this today. Platinum has surged to a new all-time high at 27.75. And that problem that occurred earlier this week, at about the same time President Trump announced tariffs on our NATO nation brothers, was a Japanese bond blowout that caused bond prices in Japan to tumble and yields to spike. This is in one of the biggest credit markets in the world. The Japanese bond market is having problems. And that, I think, is a much more underlying factor for what has driven precious metals this week. Because what happened? Well, the Greenland issue was resolved primarily on Tuesday, going into Wednesday, yet metals remain red hot and on fire. And on top of that, we've got industry and governments going directly to silver mines, trying to secure supply lines for silver, which is helping to fuel the fire under silver, driving it to more than a double in just the last 3 months alone. I've been in these markets for 45 years, and I've never seen them ever as hot as they are right now, with no end in sight. These markets truly seem unstoppable. So let's get into our update. I think the biggest problem that occurred this week occurred about the same time that President Trump was announcing those potential NATO tariffs that have now since been removed and the Greenland issue is potentially resolved, which is a bond blowout in the Japanese bond market during what was a routine auction last Sunday night that failed. And suddenly investors were dumping bonds and the yields were spiking, causing the interest rates on Japanese bonds to surge. And when you see volatility in bond market interest rates, that can create a lot of knock-on effect problems that you often don't see coming. And we've seen that a couple of times over the last 5-6 years. And I'm going to detail some of those issues in this update so that you understand exactly what's happened and what some of the unexpected consequences could be. The big problem with Japan was that they've tried to introduce some tax cuts that they don't really have a way to pay for. There's no clear funding source for the consumption tax cut that the government of Japan is trying to push through, and markets expect it to be financed through government bond issuance, said Yuki Fukumoto. The bond market is effectively the canary in the coal mine. It's hard to see a scenario where buying bonds makes sense. And I'll explain to you why that is. Let me show you how the bond market really works when it comes to values of bonds and interest rates. It's a little bit counterintuitive, so let me just give you a very simple explanation that hopefully you can see pretty easily. So focus on the line in yellow. If I buy a 10-year bond from the US government, the Japanese government, whoever, at 10%, my interest is going to be $1,000 a year for the duration of that bond. And then when the bond is due, I'll get my $10,000 back plus the interest I've gotten along the way. Now, in the meantime, you're going to see interest rate fluctuations, which are normal. So if the interest rate goes from 10%, where I locked in, to 12%, that means new buyers will get a higher coupon or a higher yield or a higher real rate of return. In this instance, it would be $1,200 a year. Now, if I want to sell my bond to that person, instead of having them buy a new bond at 12%, I'm going to have to discount the price that they're going to buy my bond at, depending upon what the interest rate is and how long the duration for that bond is. In this simple explanation, let's say that I have to discount my bond about 17%, making the sale price of it $83.33. So I'm going to take a loss on the value of the bond of about $1,700. Conversely, if the interest rate falls to 8%, any new buyers of new bonds are only going to get $800 in interest, which makes my bond at 10% interest look more attractive to them, which means I can actually sell my bond for more than face value. And they'll pay it because I've got a higher rate of return to make things about equal. So they'll potentially buy my bond at $12,500. So that's the inverse correlation. And it depends on where you lock in, how long you're going to hold the bond for, and whether you're forced to sell it or want to sell it before it reaches maturation or the length of the duration of the bond. So if interest rates rise above where you bought, you'll sell at a discount or a loss if you're forced to sell. And if interest rates go down below where you bought, you could actually earn a profit on the bond itself. So that's how the bond market works. And this is what's happened to Japanese interest rates, or the yield on the bonds, a 10-year bond, over the last 3 years. Now, the Japanese government controlled the yield, held it under 0.5% for 4 or 5 years in what's called yield curve control. So they artificially held the interest rate down while Japan continued to add new debt. In fact, the Bank of Japan owns 52% of all of the bonds that the Japanese government has issued. So that's a way to enter into QE, in a way, to stimulate the economy, to print money, to put it into the markets by buying their own bonds. But now they've let the market float. They started that in April of 2024. On the 10-year yield, that would have been about 75 basis points. And now, for the first time, the yield has gone over 1.7% since 2008. And in just the last couple of months, you can see how the yield has spiked. That makes the people that have bought all those bonds at lower yields potentially losers if they're forced to sell, if they need to raise cash. Now, if they just hold through duration or maturation, they'll get their principal back. But if they need to raise cash in the short term and they bring their bonds to market, they'll be forced to sell them at a discount or a loss, and perhaps a steep loss to what they paid. And why does this matter? Well, Japan's the 4th largest economy in the world. There are a lot of Japanese bond buyers, and not just in Japan, US, South Korea, other Asian nations, China. So the ripple effects can be quite large, much bigger than most people might imagine. And that's really where the crux of the problem is, that you don't know where there might be problems that are lurking, that a sudden change in interest rates could flush out. And one of the holders of Japanese bonds are, insurance companies. Sometimes pension companies hold bonds for long term. And you can see insurance companies have been net sellers of Japanese bonds at record rates in just the last couple of months. They're taking action to stop losses, I think, is what this really means, because they see that the yield curve control is over, yields are rising, and if they hold on to these bonds, they're going to lose more money on them. So they're dumping them. And that creates kind of a self-fulfilling prophecy. And that's what kind of led to this bad auction the other night that caused yields to spike. And we've seen this before. Liz Truss was famously the shortest prime minister in British history due to an episode of similar occurrence in September and October of 2022, when her finance minister, whose name I still can't pronounce, announced a series of large unfunded tax cuts and growth-focused policies meant to spur economic expansion, but the markets reacted very poorly, calling into the question the UK's ability to pay those loans back. What happened? The pound fell sharply, and the UK government bond yields surged, just like we're seeing in Japan right now. And bond prices plummeted conversely. And liquidity in the bond market dried up. There were just way too many sellers than buyers, which forced the Bank of England to intervene with $20 billion of new buying to shore the market up. That happened in October of 2022. This is a chart that shows how the yields spiked in blue and the pound fell in red. That was only stabilized after the Bank of England was forced to spend $20 billion in the markets to intervene, which is the last thing that they wanted to do, spend additional money to fix a problem that they didn't think that they were going to have when they were already trying to spend more money than they had to start with. And part of the problem was that there was a knock-on effect that no one saw coming. Pension funds that held British bonds were not earning enough interest on them at low interest rates following COVID. So what did they do? They collateralized those bonds by leveraging them with financial houses. And when this problem erupted, they had to sell twice as many bonds as they might have otherwise to raise capital to cover their losses. So they leveraged their bet and nobody knew it. And that exacerbated the problem, which was really an unintended and unexpected consequence. So when you see yields change dramatically in the short term, you often get knock-on effects that you never saw coming. And that's exactly what happened in Great Britain. And here's a gold chart labeled by the British gilt debacle. Gold had bottomed at that point in time, and that was the bottom of the cycle in 2022 at $1,630 an ounce. And when the British bond debacle occurred, gold popped $100 overnight, very sharply, and that was during the New Orleans Investment Conference. I remember it vividly. So gold rose due to the uncertainty over what happened in the British bond market at the time. We had a similar problem in the US when inflation reared its ugly head in 2021 and 2022 and surged from under 2% to as high as 9%. What happened? The Fed raised the federal funds rate from just over zero during COVID to 4.5% in one of the highest and sharpest rate hike cycles in a generation to fight that inflation. And the yields on the 10-year treasuries went from under 2% to over 4% in a very short period of time, which meant that anyone that bought US treasuries under 2%, if they were forced to sell them, now they would take a pretty stiff loss if they had to bring them to market to raise cash. And that's exactly what happened to Silicon Valley Bank in California. They collapsed in the second biggest banking collapse in US history in just under 48 hours. Silicon Valley Bank held a lot of Silicon Valley entrepreneurial money, big money. And when investors smelled that there was a problem with the bank because their bond portfolio was underwater, because the yields had risen from under 2% to over 4%, they started to pull their money out in a classic bank run. And then the bank was forced to sell some of their bonds to raise cash. And that created the failure of the bank. They didn't have enough collateral to cover, and the government had to step in and bail them out for billions of dollars. Another unintended knockoff consequence because the bank didn't manage their risk that they had properly when the yields rose very sharply. And this is a gold chart that shows Silicon Valley Bank failing off to the right in red, and how gold popped from about 1850 to 1975 on a bullet after Silicon Valley Bank failed. So in both of these instances, when there were knock-on effects in Great Britain and in the US over big changes in interest rates or problems in the bond market, gold reacted very sharply and moved sharply higher. And now we've got Japan, which has the highest level of debt relative to GDP of any of the major nations, 242% debt to GDP ratio. They've so far managed to manage this high level of debt relative to GDP fairly well, but that's when interest rates were lower. And now they're losing control of their bond market. According to one of the financial analyst sites where I've got this information, Japan faces long-term vulnerabilities from rising debt servicing costs if interest rates increase. And now we're seeing interest rates rising, and they've got a lot of debt, and now they've got some lack of confidence in their bond market. And bond markets are the world's largest credit markets. We saw a similar issue in the US markets last April during the tariff turmoil episode, when bond yields in the US spiked from 4% to 4.5% in a week when President Trump announced the Liberation Day tariffs. Foreign investors dumped US bonds and the yield spiked. And Scott Bessent was forced to intervene with the president, and the president pulled the tariffs back. So when you see problems in the biggest credit markets in the world, creates a lot of uncertainty, and it creates a lot of interest in gold. This chart takes you back 19 years to show you the interest rate. We haven't seen interest rates this high on the Japanese 10-year bond in 19 years. This is an 11-year chart. And all those bondholders, if they're still holding those bonds under 0.5%, if they were forced to bring them to market, they would lose market share. And who owns Japanese bonds? Well, again, it's investors in Asia, South Korea, China, Thailand, Vietnam, the US. You don't know what the knockoff effects are going to be. And I think that this has had a bigger impact on gold this week than just what President Trump has done in Greenland, because that was potentially resolved on Wednesday. But the market continues to run hot, although it's still left a bad taste in a lot of it, European mouths. But still, you've got a double whammy here now. And the Japanese bond market really, to me, is a bigger issue. Again, here's that 3-year chart that shows you just how much yields have spiked and how they've never been higher in 19 years than they are right now. And there's a lot of debt that Japan holds that now is potentially underwater if it has to come to market. And that's helped to light this fire under gold this week, moving it up from 46.40 where it was just a week ago. Here's the 1-year gold chart. And I've labeled the Japanese bond blowout on there. And now we've got over a $350 rise in gold this week once that bond blowout occurred and the Greenland episode started a week ago Saturday, actually just 6 days ago now. These markets are just on fire, and they show no sign of stopping on a 12-month calendar basis. Gold's now up 82%, and it's literally off this chart, which isn't updated yet because I'm taping this during the day while the markets are still open. It's late in the afternoon, but gold's holding right about 49.80, 49.85 as I tape this. And helping to underpin the gold market is central bank gold buying. Poland just announced they're going to buy another 150 tons of gold for their central bank holdings. And we know now that the gold central bank buying for 2025 is going to come in a little under 900 tons this year, about 875 tons, which would be the 4th year on record in the last 4 years. So there's continues to be just an abnormally high amount of demand for physical gold, and it just won't stop. Silver has been on fire too. Since Thanksgiving, when it bottomed at about $50, it's more than doubled now. It hit $103 an ounce just a little while ago. On this chart that I knocked out about 2 hours ago, it was only at $100.75. It's clearly over 100 right now. And there's a lot of fundamental reasons why silver could go sharply higher still because of so much physical demand for silver around the globe. This is a run on the bank of silver. I brought that up last fall, and it just continues, and it continues to drive the price. With silver spiking relative to gold, we've seen the gold to silver ratio collapse even further. Now it's down to 49. 0.42 to 1, with gold at $49.80 and silver at $100.75. It's the lowest ratio we've seen since 2011, when we hit that last all-time high for silver at $49. But now, of course, that's more than double. We could see this ratio compress a bit further, and it wouldn't surprise me. And I still don't think that silver is overvalued relative to gold the way this is going. We could see this ratio collapse further and perhaps to a new low on this 25-year chart, the way this market is going. Here's one of the fundamental reasons. Indian demand for silver is just off the charts. This is from Tavi Costa and Bloomberg off of X. Tavi's been tracking the imports of silver by India, and they are just at record highs in 2025 with no end in sight. As I've mentioned before, individual investors can use silver as collateral for investments starting in April of this year, where before they could only use gold. It's a much cheaper alternative as a precious metals alternative to gold for many poorer investors around the world. And Chinese are also buying silver hand over fist, as evidenced by the premium investors are willing to pay over the spot price in Shanghai, which is now hitting record highs at $12 an ounce. It's normal for this premium to be a couple dollars, but not $12 an ounce. That means they really want physical silver in China. And if they're willing to pay that high of a premium over what the New York price or the London price is. So I would watch this premium closely to give you an indication of whether the market may be softening or not. If this premium starts to really collapse, that would be the time to be wary of buying into the silver market or waiting for a dip. It's not happening yet. In fact, it's hitting record highs. I've got this from Zero Hedge just today. And of course, now we've got evidence that China is trying to buy Canadian silver right out of the ground from Canadian silver miners. So you've got Samsung investing in a mine in Mexico, the La Paria mine, 3 months ago, to secure a source for their silver batteries, which are potentially revolutionary for the EVs. And the Chinese are going directly to Canadian mines to buy silver in the ground and offering a premium of $8 or $9 an ounce over the prevailing price to buy that silver. That shows you how desperate they are to maintain their supply lines of silver, which is critical for industry due to its conductivity. And that's why I think silver has the legs and could run further. Looking at platinum very quickly, platinum is now up to 2760. It was 2745 when I knocked this chart off a little while ago, earlier today, and it's literally off the chart. So I'll have these updated for you on Monday on our social media channels, all the new charts. Platinum's up 200% in the last calendar year, the last 12 months rather, excuse me. It's red hot too. It's a great alternative to gold, expensive gold and jewelry. And even palladium is trying to break out of its channel, trading at about 2025 this afternoon, which would challenge its previous high of 2023 if we get to 2025 and hold over that on the close today. So all these precious metals are just on fire after looking like they were ready to correct just a week ago. I taped a video showing support levels because things were easing. And then all of a sudden you've got President Trump creating a lot of turmoil and uncertainty over Greenland. And now this Japanese bond market debacle, which I think is really a much bigger root cause for these precious metals runs that we've seen this week, which have just been extraordinary. If you're interested in physical precious metals, here's our Getting Started guide, which will take you to the most widely traded, competitively priced physical precious metals there are that are the best ones for you to own, the most easily sellable products for you, which is important for liquidity reasons when the time comes. Here's what our website looks like. Here are our social media handles. If you'd like to follow us on social media where I post in between these video updates. And of course, here's our YouTube channel. We'd love to have you as a subscriber. We've grown our channel quite a bit in the last year and a half, and we continue to hope to do that. And we'd love to have your support. So that is my update. And now our 28th year in business, my 46th year in the precious metals industry. We can't thank you enough for the loyalty and trust that you've placed in us. And these markets are just incredible. I've never seen anything like it in all my days, and they seem unstoppable. But keep a close eye. We're going to enter a period of volatility and a period of some profit taking. We may not be there yet, but when we get there, you're going to see some bumps. So be wary of that. And remember, the corrections that we've seen along the way so far have been short and shallow. I would encourage you to buy the dips. But when you see problems like we've seen in these Japanese bond markets, that really could portend much bigger problems down the line. And that's why I think investors around the world have flocked to metals so aggressively this week when things were looking a little quiet just a week ago this past Friday. So thank you so much. Have a great week out there.